I want to ask you something before we even start. When was the last time the IRS sent you a letter that said, "Good news! We just created a deduction worth thousands of dollars specifically for you, and here is exactly how to claim it"? Never. That letter has never arrived. It never will. And that silence is not an accident. In the past 12 months, the IRS quietly changed 5 rules that directly affect every retired person in America. No press conference, no letter in the mail, no segment on the evening news. These changes were buried inside a bill over 1,000 pages long. The kind of bill that no normal person will ever read, in a font size no normal person would bother to read it in, on page numbers no one was looking at. And the people these changes affect the most, retirees on a fixed income, people who have finished working and are now just trying to hold on to what they earned, are the ones least likely to ever hear a single word about them. 2 of these changes can put thousands of dollars back in your pocket every year. One of them can cost you thousands if you don't realize a single number moved. And every one of them was designed in a way that quietly assumes you will never find out. By the end of this video, you will know all 5 in plain English, and you will know exactly what to do about each one before a cent slips through your fingers. Before I go one more sentence, let me cut through something, because it is the reason most people click away from a video like this and leave real money on the table. If you are thinking, this is probably for wealthy retirees with big estates, I live mostly on Social Security, so this probably doesn't apply to me. Stay. You are wrong. And I mean that respectfully. If you are thinking, I already know the basics, this is probably going to be stuff I've heard before, also stay. Because I guarantee at least 2 of these 5 rules are not things you have heard before. I'd bet money on it. Every single one of these 5 changes hits the retiree living on a modest Social Security check just as hard as it hits the retiree sitting on a paid-off house and a pension. If you are over 65 and you filed a tax return this year, at least 3 of these rules affected you directly. Let that sink in. If you want the version of these rule changes that the IRS will never explain to you in plain English, the version where someone actually translates what they buried, hit subscribe right now because this channel exists to do exactly that. The rules change every year. The people who are subscribed here find out. The people who aren't, don't. Hit the button and let's get into it. Before we get into the 5 rules, I want to answer the question you are probably already asking, because the answer explains why this entire video exists. Why would the IRS change 5 rules that directly affect retirees and not bother to tell anyone? The answer is uncomfortable, but it is simple. The government has no obligation, none whatsoever, to help you pay less tax. When a change benefits you, a new deduction, a higher cap, a new credit, nobody in the government profits from making sure you know about it. So the announcement is a single line buried on page 700 of a bill nobody reads. When a change can hurt you, a penalty threshold, a cliff that can cost you thousands, the responsibility to track it falls entirely on you. The result is a system where the changes that help you stay hidden and the changes that can hurt you wait silently for you to make a mistake. That is not a conspiracy theory. It is just how the machine is built. And the only defense against it is knowing the rules yourself, before the deadline passes and the wrong decision gets locked in. Meet the couple I'll use to make these numbers real. Throughout this video, I'm going to run these numbers through a real example. A couple I will call Frank and Carol. They are both 67. They are married. They own the home they have lived in for 30 years in a state with meaningful property taxes. Between them, they collect $48,000 a year in Social Security. Frank has a pension of $20,000 a year from his career as a plant supervisor. Together, they pull about $27,000 a year from the IRA they spent decades building. Total household income, $95,000. They are not rich, they are not poor. They are the great American middle of retirement. People who did everything right, saved steadily, paid off the house, and now just want to hold on to what they earned. They are exactly the kind of ordinary retired couple these 5 changes were built around. And they are exactly the kind of couple nobody bothered to inform. By the end of this video, you are going to see how much these 5 quiet changes are worth to a couple just like them, and by extension, to you. The first rule is the one that puts money directly back in your pocket, and most retirees have no idea it exists. Starting with the 2025 tax year, there is a brand new deduction created specifically for people age 65 and older. It is called the Senior Bonus Deduction. It is worth $6,000 per person, which means $12,000 for a married couple like Frank and Carol, where both spouses qualify. And here is what makes it genuinely powerful. This is not a credit you have to chase. It is not a complicated form you have to wrestle with. It is a straight deduction that sits right on top of your standard deduction and on top of the extra standard deduction that seniors already receive for being over 65. So it stacks. 3 layers of deduction, all landing at once, representing completely new money that simply did not exist in the tax code a single year ago. Why did they create it? Officially, to give seniors relief, partly to offset the fact that so many retirees are now getting taxed on their Social Security, a problem the government itself created and never fixed by adjusting the thresholds for inflation. Whatever the political reason, the result for you is the same. A brand new pile of deduction you are entitled to that reduces the income the IRS can tax. For Frank and Carol, that $12,000 deduction is worth approximately $1,440 a year in real tax savings. For a single retiree, the $6,000 version is worth around $720 a year. That is money that stays in your account rather than going to the government. Think about how this plays out in the real world. A widow, 68 years old, living on Social Security and a small IRA, walks into a tax chain in February. The preparer she has used for years runs her return the way he always has. Hands her the paperwork, she signs, she leaves. $720 she was legally entitled to, never claimed, because the software hadn't been updated and there were 3 more clients in the lobby. She will never know. That $720 just stayed with the government. Multiply that across millions of seniors, and you start to understand the scale of what quietly slipped past people this year alone. The rules to qualify income limit: $75,000 modified adjusted gross income for a single filer, $150,000 for a married couple. Under those limits, you get the full deduction. Above them, it begins to phase out. The fix: pull out your most recent tax return today and look for the senior bonus deduction, line by line. If you qualified and it is not there, you are not stuck. You can file an amended return, Form 1040-X, going back and claim every dollar you missed. The IRS processes amended returns within 16 weeks. Critical deadline: this deduction is temporary. It is scheduled to disappear after the 2028 tax year. You have a limited window, just a few years, to take full advantage before it vanishes as quietly as it arrived. That is exactly why catching it now matters so much. The second rule is one that has been silently punishing homeowners in high-tax states for 8 straight years, and in 2026, it quietly reversed in a major way. If you own a home, you have heard of the state and local tax deduction, even if you have never called it by that name. It is the deduction for the property taxes and state income taxes you pay every year. For 8 years, since 2018, there was a hard cap on it of $10,000. It did not matter one bit if you actually paid $16,000, $20,000, or $25,000 a year in combined property taxes and state income taxes. You could only deduct $10,000 of it. Every dollar above that threshold simply vanished, no tax benefit whatsoever. For retirees in high-tax states, New Jersey, New York, California, Illinois, Massachusetts, Connecticut, this was financially brutal year after year. You wrote the checks for the full amount, and the government only lets you count less than half of it. In 2026, that cap quadrupled. It went from $10,000 to $40,400. That is not a small adjustment. That is 4 times more of your state and local taxes that you can now deduct. Let me show you exactly what that means in real dollars. Frank and Carol's numbers. Between their property taxes and state income taxes, Frank and Carol pay about $22,000 a year to their state and local governments. Under the old $10,000 cap, they could deduct $10,000 of that, and the other $12,000 simply disappeared. They paid it and received nothing back for it. Under the new $40,400 cap, they can deduct the full $22,000. That is $12,000 of additional deductions they could never touch before, worth between $1,400 and $2,600 a year back in their pocket, depending on their bracket. And Frank and Carol are a modest example. A retiree in New Jersey paying $16,000 in property taxes alone, plus state income tax on top. For 8 years, they watched most of that vanish with no deduction. Now they can deduct up to $40,400 of it. For some of these homeowners, the annual swing is $3,000, $4,000, even $5,000 a year. That is a vacation. That is a grandchild's tuition contribution. That is real money that was quietly handed back. The third rule is about what you leave behind to your family, and it reverses a deadline that had estate lawyers booked solid and ordinary families quietly panicking for years. For years, there was a cloud hanging over estate planning. The amount you could pass to your family tax-free, the estate tax exemption, was sitting around $14 million per person and was scheduled to get cut roughly in half at the end of 2025, crashing back down towards $7 million. Now that still sounds like a lot, but here is why ordinary middle-class families were getting nervous. In expensive parts of the country, between a paid-off home that is tripled in value, a retirement account built over 40 years, a life insurance policy, and some savings, a regular family can add up to more than they realize. People who never thought of themselves as wealthy were doing math and getting uncomfortable. Estate lawyers were booked for months, with clients rushing to set up trusts and move assets before an artificial deadline, many of them paying thousands of dollars in legal fees out of pure fear. The fourth rule is one that decides how much you pay for Medicare every month, and crossing the line by a single dollar triggers it all at once. There is a surcharge on Medicare premiums for higher-income retirees. It has an ugly official name, the Income-Related Monthly Adjustment Amount, but everyone in retirement planning just calls it IRMAA. Once your income climbs above a certain threshold, Medicare adds a surcharge on top of your standard premiums, charged every single month. In 2026, those income thresholds quietly moved upward. The first threshold is now $109,000 for a single retiree and $218,000 for a married couple. A higher threshold means a little more breathing room before the surcharge touches you. Good news on the surface, but you have to understand the cruel mechanic underneath it, because it is unlike almost any other tax in the code. This surcharge is a cliff, not a ramp. With normal taxes, if you earn one more dollar, you pay tax on that $1. Reasonable. The Medicare IRMAA surcharge does not work that way. If you go one single dollar over the threshold, the entire surcharge slams down on you. Not a little bit for a little bit over, the whole thing all at once. The first tier alone adds over $1,100 a year for a single person. For a married couple where both are on Medicare, that is more than $2,000 a year. And it can be triggered by going $1, a single dollar, over the line. I have heard from people who took out an extra $100 from an IRA, crossed the threshold by $40, and paid over $1,000 in surcharges for it. That is how unforgiving this cliff is. Think about how sneaky that is. A one-time event 2 years back, selling a rental property, taking a large IRA withdrawal to help a child with a down payment, doing a Roth conversion, can reach forward 2 full years and spike your Medicare premiums today, long after you've completely forgotten about it. People get a letter saying their premium jumped by thousands, and they have no idea why, because the cause is buried in a tax return from 2 years earlier. The fifth rule is one that almost nobody is talking about, and it can hand you a brand new deduction worth thousands of dollars, but only if you bought the right car at the right time and know the rule exists. For as long as most of us have been alive, there has been one iron rule about car loans. The interest is never deductible. You could deduct mortgage interest on your home. Decades ago, you could even deduct credit card interest. But car loan interest? Never. It was simply money you paid and never saw again. Generations of Americans accepted that as a permanent, unchangeable fact of life, something you never even questioned. You financed the car, you paid the interest every month, and the tax code gave you absolutely nothing back for it. In 2025, that quietly changed for the first time ever. Buried in the same 1,000-page bill is a brand new deduction that allows you to write off the interest you pay on a car loan, up to $10,000 of interest per year. For the first time in the modern history of the tax code, the interest on your car loan can be deductible. And here is the part that matters most for retirees. This one does not even require you to itemize. You can take your standard deduction, take your senior bonus deduction, and still claim this on top of both. Starting with the 2026 tax year, the company that holds your car loan is required to send you a brand new tax form showing exactly how much deductible interest you paid. It is a form that did not exist a year ago. Most retirees are going to receive this piece of paper in the mail, not recognize it, assume it is junk mail or a routine statement, and throw it in a drawer or the trash. and with it goes a deduction that could be worth real money. The form is the government quietly admitting the deduction exists while doing absolutely nothing to make sure you understand what it is or what to do with it. For an ordinary retiree like Frank and Carol, comfortably under the income phase-out thresholds of $100,000 single and $200,000 married, the full deduction is on the table if they financed a qualifying new car. Now let me pull this together, because the pattern matters more than any single rule. 5 rules changed quietly, all buried in legislation, all with essentially no effort to inform the people they affect the most. 2 of them, the senior bonus deduction and the quadrupled SALT cap, can put thousands of dollars back in your pocket every year, but only if you know to claim them. For Frank and Carol, those 2 alone are worth somewhere between $2,800 and $4,000 every single year. Money sitting right there on the table that they would have left behind if nobody had told them. The estate tax change gives your family certainty, removes an artificial panic, and tells you to redirect your attention to where the real risk actually lives, your state's threshold, not the federal one. The Medicare IRMAA rule can save you from walking off a cliff you never saw coming, and one specific form can recover thousands of dollars for newly retired people who are being penalized on income they no longer earn. And the car loan rule hands you a brand new deduction that has never existed before in the modern tax code, if you know to claim it and don't accidentally throw the form away. The most important thing I will say in this entire video: the system is not built to inform you. Read that again slowly. It is not broken. It is not an accident. It is working exactly as designed. The IRS does not profit a single cent from telling you about a deduction you are owed, so it does not tell you. Your tax software does only what it was programmed to do, and the programming lags behind the law. Your preparer is a good person buried under hundreds of returns in a 4-month season, and the new rules do not all make it into their head in time. Nobody anywhere in that entire chain has a job that depends on making sure that you personally, by name, keep the most of your own money. That responsibility falls on exactly one person in the whole world: you.